Well, welcome to Mortgage Express. I'm Dawn Hall.
And I'm Mallory Fraser.
And we are going to talk about today, got a little love theme going on because, February, Valentine's Day. I'm sure you celebrated Valentine's Day. I did not.
Sort of. We don't really celebrate Valentine's Day. We just do because, my husband and I we go to dinner all the time. So it's more of like we just made dinner together. And then I ate a lot. That's about it.
Okay. All right. Well, so moving on to that, what we're going to do is it's kind of themed to, do you still love your mortgage?
Yep.
Is it still working for you? Is it something that you want to continue to do? Mm-hmm. So we call them checkups. When was the last time you checked on your loan? Mm-hmm. When was the last time you made sure that escrows were being taken out correctly, your payments are on time, they're going to the right place. Yep. Also looking at rates and things like that. Sometimes you have changes. Absolutely. What's the market doing, all of that. And then, maybe you need to do something else with the equity or whatever in your home. So we're going to kind of talk about and touch on all of these things and kind of call it our mortgage love checkup.
Yeah. If you still love that mortgage or not.
Right.
I know we love our mortgage because we can't get rid of it at the moment. It's perfect.
Because you've got one of those 3% ones or something, don't you?
Yeah, my husband got his house, our house now, but it's in his name. But it was the COVID prices, and I was like, you're lucky, you lucky man right there. And I tell him all the time, I'm like,
He did a good job.
He did a good job, and where we are is great, and I love it. Yep. He really did it. But so when we talk about like a mortgage checkup, and we don't mean you need to go deep diving and talk to a lender, but we just say like, look over things. I like to do it every year, especially at November when those tax bills are coming out, because that's when I go, all right, let's look at the tax bill. Let's see if our taxes are going up, if they're going down. Mine went down this year. Thank goodness.
And they might, let me just throw that throw this in, and they might go down more because apparently it has gone through part of the Senate, whatever, with
the Senate.
in our state, where they may be getting rid of things that are not related to school. So all the things on your taxes, basically cut a lot of it out. So it may go down. Let's keep our fingers crossed.
Yes,
anyway.
I agree. But I always say that when those property tax bills come out, that's a good time to check on where everything is at. Checking on your homeowners association, not that insurance. Right. I always get HOA and HOI is like always together for me. But insurance is a big thing to always check on because rates and insurances are going down.
Yes.
Ours went down. We got switched out of the homeowners insurance that we had, and it's now lower. And I was like, heck yeah,
and
let's do it.
Yeah, that'll help with your monthly payments.
Yes.
Because insurances have been going up since after the hurricanes, but now in our area they have started coming down. Now, not in the Tampa area and all of that, but they're going to
more locally.
Yeah, and it's going to get better in the next few years as you go through Florida and we're not hit by hurricanes.
Yep.
So,
and that was actually one of the things that I remembered and truth story, this is how I say always check your mortgage, always just keep an eye on it, because after Ian, we had how many insurances just pull out of Florida, and ours unfortunately was one of them that we had. And we didn't even notice that they pulled out, didn't even notify us, or it did, and then during the hurricane lost in the mail of the scuffle of everything, and we ended up getting forced insurance on ours, and we saw our monthly bill just jack right up, and I went, wait a second, hold on a second.
Yeah.
And I said, honey, let's look at this, and I said, oh, here it is, here's our problem, let's go start
real
shopping.
Insurance.
Yeah, let's go shopping again, and then we got
forced
fixed.
place insurance doesn't help you as the consumer.
It helps the bank.
It covers the bank. It basically says that if your house gets demolished, their loan gets paid off.
Yeah.
But you don't get to rebuild your house.
No.
So, yeah.
No. Yeah, and again, we'll talk a little bit more about like the if you have mortgage insurance, if it's your first time home buyer and you're like, okay, like I had to get the PMI or the MIP for a little bit, maybe this is a good time to check on things and actually look and see if you can get that off too. Because if you got enough equity, you can probably take it off.
That's true. That is very, very true. So, we kind of talk about different things like comparing your mortgages, your relationship. You're not really breaking up. You're just changing things around. Just like in a regular relationship, you got to clean up and look at what needs to be changed, what needs to move forward. Again, do you know your interest rate? You'd be surprised at how many people don't know what their interest rate was. I am doing a loan currently, and the gentleman thought his interest rate was a 6%, and he was at 8.5%.
Yeah.
I mean, and we're going to refinance his house and do what he needs to do to get some cash. But in addition to that, we're lowering his rate by 2 points, which, allows him to take more money and keep his mortgage very similar to what he was doing already. The other thing you want to look at is your rate competitive in the market? Just like that again. I mean, if you have a 6% rate, 6.5%, you're in where the market is now. But then again, if you've got a ton of equity and all of that, you may want to take some out and lower rates on other things.
Absolutely.
So, and you want to also take a look at, is your loan a fixed rate? Or is it an adjustable rate? Was it fixed for 5 years and now it's going to start adjusting? Which could mean you might have gotten a 4 or 5% interest rate, but if it starts adjusting, maybe it's going to go up 2%,
2 points,
or 3%, which now would be a good time to lock it in at a 6 if it's going to go up to a 7.
Absolutely.
And do that kind of thing. So again, think of a mortgage checkup as thinking of, can we lower the payments? Can we get a better rate? Will it help us save something? Make things a little easier for you.
And that's as simple as like, hey, send us your monthly bill and we'll kind of glance over and see if it's like, hey, do you want to go at least get into the application process and see what we can do? Because if you're right there teetering on like a 6.7 and you want the 6.25 rate, sometimes that might not even really change your payment or change anything. And we're like, you know what? It's just not there for you. It's not that much. Let's just wait a little bit longer.
Because that's what we're going to do, is we are going to review your mortgage and make sure it's still working for you.
So equity. So when we talk about equity, it's the value of your home. So it's what you owe and then what your home value is. So we're just going to do like rough numbers. So you say you owe $300,000 on or your house is worth $300,000 and you have $150,000 mortgage of leftover. You have $150,000 in equity that you can get out. You can either, refinance and maybe do some debt consolidation. You can use it towards, hey, I want to build a pool if you don't have a pool. You can upgrade things. My personal favorite is what I do is like a home equity line of credit, which in Florida, which we are prone to hurricanes, I like it as your emergency savings if something happens. Because imagine, again, Ian comes through, which it did, and a lot of people went into so much debt just because they had to fix their fences
before the insurance came, or they didn't have insurance. Speaking of doing that, most people, we recommend, whether you use an equity line or not, if you own a home and you have a first mortgage and you have a little bit of equity, whether it's $10,000, $20,000, whatever, you should always have an equity line at your disposal. We're not saying use it and fill it up and have all these payments, but again, if you have $20,000 sitting aside over here and all of a sudden your roof, something happens and it's not covered under insurance, you get your roof fixed.
Yeah, because I don't want to be ruining my credit cards. Because I mean,
filling those up.
If you think about it, it's like a house credit. It's like your house has a credit card. That if anything happens, you can use that, and that is, it's interest only payments, and that's what. And you only owe what you use on it, just like a credit card. So instead of maxing out your credit cards for
at a higher interest rate,
at a very, very high interest rate, it's so much easier. And also, say you're not using it. Say you have, perfect example is our lovely leader Tim Hart made a comment about it, of like travel sports. Your kids had travel sports.
That is true. That's so expensive.
And to where you're going, like, if that, I have a lower interest rate on that, why don't I just pay it on that, use that, and then I'll pay that off instead of your
have
credit
your
card.
Equity work for you.
Yes.
I always say, let your equity work for you, because yes, you're trying to get that house paid off and have all that equity, but that's what the equity's for.
Correct.
Is have it work for you. And and sometimes people even buy other properties with their equity, or invest and make their money, again, make your equity work for you.
That's what I've been trying to, that's what my husband and I are working on. We're thinking about an equity line to buy a lot. And again, I'm not in a balloon payment I don't have a balloon payment for 5 years. I'm just doing interest only payments. I don't have to build in the 3 years of like having a loan. I can just hang out with it. We can pay it off. And then when we're ready, we'll pay that off.
And use the equity for that. That's a whole nother one when we start talking about construction loans and land loans. We'll do that a little later down the road. So keep an eye out if you need it. So one of the things that a lot of people have on their loans is PMI. PMI is a conventional term, and it means private mortgage insurance.
It is not bad. It is not.
No.
Just because you have PMI is not bad.
It's
MIP
not a bad
is
thing.
not bad.
Right. And MIP is the FHA term,
Correct.
which is mortgage insurance premium. Same thing, same idea, same. For conventional, when you put less than 20% down, you will have mortgage insurance. And how much you pay is based on how much money you're putting down, how your credit score is, what your debt to income is, a lot of different reasons. For FHA, it's always on there. Depending on how much you put down to begin with, when you can get to a certain point. But the thing with PMI on a conventional loan is you can request to have that removed when your home does have 20% equity into the home. Now, how do we get there? That's a question we're asked all the time. Well, if you've had your loan for 5 years, very little of that money has been going to your principal. Most of it is interest, but there has been some going to that principal. And theoretically, not necessarily this market, but moving forward, we hope, houses will increase in value.
Correct.
So investing in an appraisal sometimes will let you know that you now have 20% equity, and you can actually petition or send that to the mortgage PMI company.
Absolutely.
And then they will remove that PMI.
Also,
It doesn't fall off. A lot of people will say, oh, when you get to 20%, it falls off. It does not fall off. The PMI companies are not going to call you and say, hey, do you not want to pay us anymore? You need to call them. Or maybe you're ready to refinance and we can get that off. There's a lot of different reasons, but PMI could save you, if you get it off, it could save you anywhere from $20 or $30 a month to hundreds of dollars a month, depending on how much the payment was and when you got it. Because, of course, just like rates, PMI rates change as well. So maybe getting it 5 or 6 years ago might have cost more than it is now. And again, and who knows, maybe if you are refinancing and you're going to drop it where maybe you still have, maybe you're at 85% loan to value, but your PMI goes down $200 a month.
Absolutely.
That might not be a bad time to refinance and get that changed. So dropping your PMI can save you some money and also can, give you more equity, that kind of thing.
And so we're saying, is your loan still right for your life? And it's like the whole gist of this webinar is always checking where you are in your life. Have you lost a job? Did you get a new job? Now, getting a new job, always make sure that you can pay, it fits into your budget and everything like that. But also, it's just Do you want to upgrade? I want to upgrade. Do you want to downsize? Are you ready to, you know what, the kids have left the nest, now this is a big house, we don't want to do this anymore, we want to go smaller. That's a good way to do it. Is your payment still comfortable where you're at? Are you going like, this is just, it's starting to get too high for us, we don't like this, like
taxes and insurances have made payments go incredibly high. So a lot of people who could afford their homes can't now.
And so it's always a good thing to just look at
selling it and getting something smaller.
Absolutely. If you want, and if you've got enough equity into your home that you can sell it, make money, you can also use that as a down payment. You could have enough equity to put the 20% down on a new home, and there you go. You don't even have PMI anymore.
Yeah.
And you're like, that's great.
Yeah, and that is, some things that you have to consider, is, again, in your mortgage checkup, is this still working for me?
And I want to also, when you're choosing, when your loan options, when we're considering it, because most of the time is what we do when we look at your application, we go, okay, this is how much they're making, this is how much the payment's going to be. Let's go conventional, let's go FHA. But then we'll go back and forth. We'll go, and we are the ones that sit here and we'll go,
put the puzzle together.
This is what is best for you. This is what we think. And when people are like, I want a conventional, I want 5%. Okay, awesome. But the FHA has a better rate. Well, I don't want FHA. I don't want to do that. We understand, but if it's a better rate for you and it's a lower rate, we say take that. Take the lower rate, and then we can refinance you in a year. We want to get 2 years. We want to get you into your house with a payment that's not going to scare you or be
payment shocked
at the very end or anything like that.
And people do have that mentality that FHA's not for people, for good qualifying buyers, but it's not. All FHA is it has less stringent credit guidelines.
Yes.
It allows for lower down payments. And here's the funny thing: FHA rates right now are usually like 1/4 to 1/2 point lower than a conventional. And in addition to that, FHA allows you to finance part of that mortgage insurance premium so that monthly you're paying less.
Yes.
So again, it's lowering your payment to make it better for you, to get into that house and all of that. So, and again, the mortgage insurance that you finance up front, if you refinance your house or sell your home, you get a portion of that back. They prorate it. So, again, FHA is not because you have bad credit or you can't do anything. I mean, there are a lot of people that have 10% down, and if they do an FHA loan, they have less mortgage insurance, lower rate, and it just... Why not?
Why not?
Exactly.
Why not?
It's not hard to do. FHA appraisals back in the day used to tear them all up and make them fix all this stuff, and they don't.
No.
They really don't anymore. So
and it's just a difference of like what we see and what we think is better for you. I mean, we will always come to you and say like, this is what, and if you don't want it, that's fine.
Right.
And
we're not here to twist your arm.
We're just going to be like, we're going to find the best deal for you.
Correct.
And then when you're thinking about rates of like adjustable versus a fixed, so again, a fixed rate is going to be that rate for the 30 years, unless you refinance, and then obviously. But for an adjustable rate, so there's all different ones. But when you think of an adjustable rate, it adjusts, and it could be 3, 5. Yearly,
1
all
year
over.
adjustables,
And some people who know that are like, hey, I know I'm going to refinance in 3 years. Sometimes our 3-1 ARM programs are
a better rate.
And then it's like, hey, if you know you're refinancing in 3 years, why don't we just do that?
Or it could be a starter home. And you know that you're going to need a bigger home in 3 to 5 years because maybe you just got married and you know you're going to have children and you know you're going to need a bigger house or whatever the reason is. And the marketing or the I don't even know what I'm trying to say. Most people stay in their homes 5 to 7 years most of the time.
At least.
So, needing a 30-year fixed loan is not always the best thing for you. So.
Yeah, I mean, your main goal is always just align it with your future plans. Again, if you know that you're not going to be staying there for 3 years, or you're going to refinance in 3 years, take a look at the 3-1 ARMs. Take a look at something.
Exactly.
Let us know too, because then that way we can put it into a plan for you.
Well, and even when you do your mortgage checkup, say you've been in your house for 5 years and you're thinking, okay, in about 3 years, we're going to build a new house. So maybe you're in a 7% interest rate, and maybe the 3-1 ARM is 5.5.
Yeah.
What a great time.
Right.
To refinance and save money for the 3 years while you're going into that.
Absolutely.
All right. So during the mortgage checkup, we want to take a look at what's going to be best for you. And they're simple. There's no obligation for you to continue forward. It doesn't cost you anything. And a lot of times it opens your eyes to more things and different things to do, maybe even getting you ready to buy a different house. Maybe this mortgage is okay, but here we can set you up on what you need to do, moving forward. We are going to sit down, and as you had said earlier, we're going to analyze everything. We're going to look at your rate. We're going to make sure that rate is still something that works for you. Maybe it could be a better rate. Do you want to do something different with your equity? Do you want to get rid of the PMI? We keep kind of saying the same ideas, but that's what we do on your mortgage checkup. It's very similar. I think we talked about pre-approvals, pre-qualifications.
Absolutely.
Same idea. It doesn't cost you anything. We do a soft credit pull to begin with. Of course, depending on what program we put you in, we may or may not need to do a full credit report. We may or may not need to do an appraisal. So, fees and all can be condensed or cut down. It just kind of depends on what we're doing and what we're going to go, and put together for you. So we definitely want you to call us. Let's schedule something. Let's look at your mortgage and make sure what you're doing and where you're going with it is where you want to go.
And it could be easy at just sending in your mortgage statement at the beginning and saying,
and for us to take a look at.
Yeah, just look at that. Let's start there and then go from there.
And this is kind of basically what we've got going on, is kind of tying it all together. We want to make sure you're qualified. We want to help you get in a better position. We want to get you ready for the next stage of your life. I always go by, I'm your mortgage lender for life, and that's what we want to do. We want to be able to help you through every stage, and a mortgage checkup once a year is one of those stages that we need to do to help you be where you need to be.
Absolutely. I mean, you don't have to watch the rates like a fiend and watch them go down, or because again, mortgage rates fluctuate every single day, sometimes multiple times in the day. But it's also one of those things of like, hey, I always do for a rate check 2 years. I mean, not for our mortgage, because we were very lucky, but I do say, like, when good friends of ours, I helped them buy their house. Was their lender, and I said, hey, unfortunately, a month after they bought their house, rates dropped. And he was like, dang it. And I said, no worries, hang out. You can afford this payment easily. You're good. In 1 year, let's check back and see where we're at and see if this is still going to be a good idea for you.
And rates probably have dropped further, now it's probably...
they have. Yes, and they have. So, and I keep telling them, I'm like, hey, just let's wait till next year. We're good. He's still at a good rate, which that's where he was like, okay, I still know I'm at a good rate. And I'm like, yes, you are. I said, don't worry about that. But then he said, yeah, let's just wait until next year and then reevaluate everything.
Right.
And I do tend to tell my friends who own houses and everything, I say, that yearly tax bill, that's
time
your
when-
reminder to check
Right.
everything.
That is
check
true.
your insurance, check your
Oh,
tax
yes.
bill.
Because do you know how many people don't look at their homeowner's insurance? Same thing
No.
with car insurance. People don't look at it. And just because you're escrowed does not
Yeah.
mean you can't change your insurance.
No, you can change it whenever you want.
Exactly.
You can change it
and then
whenever you want.
they contact us or your lender, whoever's servicing your loan, and they make those changes. So
Yeah, you don't even have to go through a huge process of just like, hey, I want this one, send it into your
Yep.
servicing department, and they'll take care of everything, and just making sure that it's aligning of where it needs to be coverage wise, and
Yeah.
it's simple. And I look at that mortgage statement. My husband makes fun of me because I'm constantly looking at it. He goes, it's on auto pay, babe. Like, we're good. And I said, I always make sure. I always just at least open it really quick, and then I just toss
And make sure
toss it aside, because that
you'd be
one,
surprised at how many
that one
computers
after-
have glitches sometimes.
Yeah, that one after Hurricane Ian, that one mortgage payment when I went, whoa. I said, what happened here?
Right.
And then I went through, and I said, and I found out it was the insurance. It was the insurance.
So I guess what we want to leave you with today is give us a call. We want to review your mortgage. We want to take a look at it. If you've got any kind of questions related to anything, call us. That's what we're here for.
Yeah.
We want to help you. We want to teach you. We want to inform you. So give us a call. We'd love to help you. We'd love to take a look at your mortgage and see where you need to be. So again, Dawn Hall,
Mallory Fraser.
we're your Mortgage Express team.
See you later.